BATCHIMPIPS. All right, y'all, I'm just going to jump right into it today. I know I usually do a little segment in the beginning where I show my face and talk a little bit, but I hadn't shaped up my beard. Your boy's looking scruffy around here, so I just don't want to be on camera looking all like a bum. So let me let's just jump right into it on the screen share. But this is my Omega trade strategy that we're going to talk about today. So here are the rules to the Omega trade strategy. Rule number 1 is the H1 candles are, and this right here is just overbought or oversold. The H1 candles are overbought or oversold between the 50 and 144 EMAs, which is my gold and purple line. All right. So right here, this is what we're looking at. Prices between my 50 and 144 EMAs, like I said in rule number 1, the gold is my 50, the purple is my 144 EMA. As you see, prices moving primarily between those two. Yes, it peaked up above the 144. That's fine. As long as the bulk of the formation is between the 50 and 144, we're cool. Also, rule number 1 says it has to be overbought or oversold while it's in that area. And right here, we see that price is indeed overbought. Cool. So rule number 2 is the confirmation candle body must close past the last prominent wick in the formation. So what we're doing is we're looking for a confirmation candle to say this is definitely going to be a sell. And as rule number 2 says, it has to close past the last prominent wick in the formation. So let's see, how do we find that? Well, let me do it this way. I'm going to draw a vertical line right here because actually right here. This is kind of where I would start looking at this just to see if it's going to turn into an Omega trade. The reason I'm starting to look right here is because price is between the 50 and 144 and it's already oversold. So now I'm just kind of keeping an eye on it. So my first prominent wick, I would say, is probably about right here. So I'm going to draw a horizontal line right here, and price comes up and then it comes down. It wicks past it. And so I'm starting to look at it now like, is the candle body going to close past that? Well, it wicked past it, but it never closed past it. So the body of the candle did not close past this. Then it came up. And also at this point too, it made another prominent wick. So I'm going to adjust my point here. So now I'm going to say this is my last prominent wick in the formation. So now I need a candle body to pass this. Comes up, down a little bit, back up. I think this is another good area where I can say this is pretty prominent right here, these wicks, these two right here. And then we finally have the body of a candle close past the last prominent wicks, which is what rule number 2 says. The confirmation candle body must close past the last prominent wick in the formation. All right. It doesn't matter what time the confirmation happens. It does, however, matter when you enter the trade. So don't worry about, I know I have another strategy, my angel dust strategy. It matters what time the confirmation candle happens. In this one, it doesn't matter. However, when you enter the trade, you still have to be within our acceptable trading times, which we'll get into in just a little bit. But this confirmation candle right here is the confirmation candle because the body of this candle closed past the last prominent wick. Rule number 3, after the confirmation, enter the trade when M15 comes back to grab the 50 EMA. Y'all should know by now, if you've seen my other videos, that's how I enter trades. I go down to the M15 chart and then, oops, I didn't move my line on accident. It was right here. But I go down to the M15 chart. Price fell a little bit and then it came back up and it grabbed our 50 EMA on the M15 time frame, which is, remember, that's the gold line. So we enter the trade pretty much right here. And then you would have had approximately 8 pips of drawdown. And then you could have caught about 125 pips pretty easily. I mean, it kept going down. That's about close to 200 pips that you could have caught on that. So that's essentially all the rules to the thing. So let's recap real quick. Number 1, price has to be overbought or oversold while it's hovering between the 50 and the 144 EMA. So here we have price between 50 and 144 is overbought right here because it's above our 90 level, this 90 level right here. Another thing I want to mention, for it to be a valid overbought, I need this to be, I'm going to just zoom this up. You see how I can see a little space between the 90 line and the green line, how it makes a heel over it, and I can see some clear background chart behind that. That's what I want to see to be like. If it's just barely touching this line, I'm not going to count that. I need it to be a very clear hump over that 90 level right there. So we have that. That's rule number one, is between the 50 and the 144, and it's overbought. Rule number two, our confirmation candle body, the body, you got to remember it's the body, has to pass, close past the last prominent wick in the formation. We have that. Then we go down to the M15, wait on it to come back and grab the 50, and which we saw already. So let's just go ahead and find another example. Oh, well, here's one right here, actually. I'm going to go ahead and show this, but I can see we would have missed this trade. However, it does still meet the rules, it looks like. So, but I can just tell the entry would have been before our trading times, which let me actually just put that out here right quick. I'm going to have this in the description, a link to these rules in the description. So you can go ahead and just have it to save or whatever. But these are our acceptable trading times. Now, the one we're currently looking at or about to look at, I can tell that the entry was supposed to happen in New York session technically, but it happened right before 6 a.m. Another thing I want to mention real quick is all my times are in Central Time now. Previously, I used to have them in Eastern Time, but being that I'm the one that's doing this tutorial and I live in a Central Time zone, man, y'all just help your boy out, man. I'm trying to cater to myself just a little bit, so it'll make it easier on me to say all my times in Central Time, because that's what I'm used to. And y'all just convert it to whatever you need to for whatever time zone you live in. But so 6 a.m. is the earliest that I'm willing to take a trade. But let's look at this right quick and just go through the rules real quick. Rule number one, price has to be between the 50 and the 144, and it has to be overbought or oversold. Well, here it is. This is what we're looking at. Price is between the 50 and the 144, and here we go. We have overbought is clearly above the 90. Rule number two, the confirmation candle body has to close past the last prominent wick. So this really only has one prominent wick, which is right here. So we're going to draw a line right down at the bottom of that, and now we need a confirmation candle to happen. Well, this candle almost passed through it, but it didn't. You see it wicked through it, but it closed above it. This candle, however, did close past it. So now we have a confirmation candle body that closed past the last prominent wick. Now we go down to the 15-minute chart. Scroll back over here. And we wait on price to come back and grab our 50 EMA, which is the gold line. Here it is right here. So this would be the entry point. However, this entry happened. I knew it. 13:45 chart time, which is going to be equivalent. See, that's 13. It's right before our 14 chart time. So basically, this is 5:45 a.m. Central Time. So I would have missed that. Plain and simple. I would have missed it. However, this would have been a good entry. Even so, still it's 170 pips that could have gone. But real talk, I'd have missed it. But it does still show overall the strategy working, aside from the trading time being jacked up. Let's try a different pair though and see what we can find. Actually, yep. I actually took this. I didn't catch that many. I only caught like 50 pips on this thing. It was ugly, but let's talk about it anyway, because you're gonna see some trades that don't look they ain't that pretty. So rule number one. Prices between the 144 and the 50 and the 144. This one's harder to tell because it's not really flattened out. But you see all this price information between the 50 and 144, and then as well over on this side. And right down here we see is overbought. Cool. So that's rule number one met. Next thing we need to do is find where's the last prominent candle in this formation. Let me highlight the entire formation right quick. let's find the last prominent candle. So at some point, I'm sure I'm going to have my line down here. But once it comes up a little bit, came down, back up, I would have adjusted it, or I did adjust it. And I said, this is my last prominent set of wicks. And it doesn't have to be a set of wicks. I know I just said a set of wicks, but it's just one wick. But this is where the last prominent, thing of wicks are in this situation, though. And then also, this is why it's very important to draw your lines real precisely. Let me zoom in a little bit. Notice this candle body, it did close past this last prominent wick. Barely, but it did close past it. If I would have had my line drawn, off a little bit like that, I might have missed it. So you got to have it perfectly drawn at right under the last wick. So this candle body did close past that wick. So now we go down to the M15 chart. And so that's pretty much around where that happened. And then price came up. It grabs our 50 EMA, our gold line right here. So here's our entry point. And then we would have had about 9 pips of drawdown. So market would have went against us and we'd have been in the negative 9 pips. But then it gives you a smooth 100 pips right there. I got in this trade late. I remember I got in right above up here. And I got in after I was supposed to because that was 4 a.m. But the only reason I went ahead and took it anyway is because I said, well, it came back up to where I would have got in the first place. And so I just went ahead and took it and then just made a smaller take profit point than I normally would have. But anyway, let's just go ahead and look at a different example. Let's see if we can find something else. Okay, here's one. Actually, nope, that ain't one. All right, let me try a different pair. Oh, and that's still highlighted from the last one where I took it, I guess. All right, so let's talk about this one. Prices between the 50 and the 144 EMA. Actually, you know what? Let's talk about this first. Here's an example of one you don't want to take. It looks good on the surface, but I'm going to show you why you don't want to take it. Remember when I told you, we're also going to look at this one. This one was good. I remember taking this one. I caught all this mess. This one, you don't want to do that. Notice how this is very blatantly overbought. We can see some space between that hump that the Ehlers Fisher makes over that 90 level versus this one. Yes, I mean, you can tell it's hitting that 90 level, but it's not over that mug. You know what I'm talking about? So that right there, when that happens, you probably would have been safe to take this trade. Let's see, because what's that? November 24th. I'm just trying to see something real quick. Yep. So by the time you would have gotten in, because this is where it came back and grabbed the 50 level. Was that at an appropriate time? Yep, 3:30 in the morning, my time. So you could have got in right here. You would have caught 35 pips, and then it would have came back and, jacked you up. But essentially what would have happened is, or in my situation, I just know by the time it got down here, I would have got in right here where this line is. I would have adjusted my stop loss to +1 or plus a couple of pips. So it would have came down. It would have been a risk-free trade. But by the time I woke up in the morning, it would have knocked me out the trade. So, but what I'm saying is avoid that in the first place by not getting in because it wasn't oversold or overbought enough. So now let's look at this example. Let me clear this up a little bit more so we know what we're looking at. Now we're looking right here. We're clearly overbought while price is between the 50 and the 144 level. And also, notice in my rules, I have here the H1 wick should at least pass the 144 EMA. This is what I'm talking about. And the other examples that we looked at, the whole body of the candles were above the 144 at some point. As long as it wicks past the 144, you're good. And right here, that's what we have. It's just wicking past it. So that's, as long as you got that, you're good. So we're overbought prices between the 50 and 144. That's rule number one. Rule number two is we got to find where the last prominent wick is. So I would say here's a prominent wick, but that's not the last one. The last one I would say was probably right here. So boom, here's the last prominent wick. Here's a candle body closing past that last prominent wick. Cool. So now we go down to the 15-minute chart and look for an entry. Let's see, we're on November 19th. Okay. So it passed it down here. Price came right back up on the 15-minute chart pretty immediately and grabbed the 50 EMA. Here's our entry point. We have no drawdown whatsoever, maybe 1 pip. And then it just shoots down almost 100 pips right away. The reason you could have known to get out of that, by the way, I mean, this is your last major, this is a pretty big support level. So you can pretty much bet that price is going to come down here and bounce off of that because it did it right here really abruptly. So you essentially would have caught 84 pips, 85 pips, and then got on up out of there. Or just set your take profit point right there, so it would have gotten you out. So that was a great trade. Let's see what else we can find. Okay, here's another one that looks like, price is where it needs to be. It was never oversold. I'm sorry, overbought. It was never overbought right here. I really hope I find an example that's a buy, because everything we're looking at has been a sell so far, and I really want to find something that you can buy. Tell you what, I'm finna just start scrolling like a mug, and so dang, hallelujah, here we go. Right, dang. All right, look, this is why I don't hold trades over the weekend. I'm finna just go off on a tangent real quick. You see this big old price gap? This is a weekend gap. Price ended here. Dang, that's a 95 pip gap. So you could have been in profit on a buy right here. And then Sunday afternoon, when the market opens up, it started all the way down here, because that's August 2nd. Go down to the 15-minute chart. You'll see it better. So yeah, you can see the gap a lot better here. But yeah, it started down here, 95 pips below. You could have had you could have had your stop loss in profit and everything. It would have ate all of that mess. That crap right there is why I don't hold trades over the weekend. 99% of the time. Like, I'm rarely going to hold a trade over the weekend. But anyway, here's an example of a buy situation, and then we'll call it a day. So here's where we're looking. It's right here. Prices between the 50 and the 144 EMAs, and it's oversold, very blatantly oversold, because it's well under our 10 level down here on the Ehlers Fisher. Cool. There's rule number one. Rule number two is we find the last prominent wick. So that would be, I would say here, right in this area would be our last prominent wick. And then this candle body closes past this last prominent wick. There's rule number two. Now we go and look for an entry. So we go down to the 15-minute chart on, let's see, that was July 28th. So that's where we broke past the wick. And now we're just waiting on it to come back and grab our 50. Bam, there it is right there. So as soon as it touches that 50, we hop in. We have absolutely no drawdown. So that's a sniper entry if I ain't ever seen one. And then you ride that on up and get out before the weekend hits. So essentially you would have caught roughly almost 100 pips. It would have been 90 some odd pips that you could have caught on that safely and gotten out before the weekend. That's all it is, y'all. It's just 3 simple rules. Make sure the candles are between the 50 and 144 and that it's overbought or oversold. Rule number 2. Your confirmation candle body closes past the last prominent wick. And then rule number 3, go down to the 15-minute chart and wait on it to grab the 50 EMA. And then you hop in the trade. It's that simple. So if you have any questions. Oh, one thing I do want to mention, and this is notice this is not divergent. My other couple of strategies that I've showed you, everything has had to be divergent. Oops, I just grabbed the wrong thing. But the candles show prices going up here, and the English Fisher also shows prices going up. That's not divergence. We don't need divergence in this strategy. We simply need for price to be overbought or oversold anywhere at some point while it's between the 144 and the 50 EMAs or whatever. Just as long as it's overbought or oversold somewhere in the formation. Divergence don't matter. So just throwing that out there. But anyway, if you have any questions, just drop them in the comments, and I'll try to answer that as best as I can. All right, y'all.